Hey everybody, welcome back to Is It a Buy, where we talk about stocks and try to determine if they are worth a buy or maybe a pass. My name is Corey. I'd just like to preface the video by saying I'm not a financial advisor. I'm just a guy who likes to talk about stocks, so please take what I say with a grain of salt, all right? Huge video today. Today we have a special guest. We have atobitt on the channel, okay? And atobitt is very, pretty famous, I would say, on Reddit. I'm sure a lot of people saw this post here called GameStop has or Citadel has no close. Okay, this is very, very popular. You can see all the words here. Huge deal. So very to have you on, atobitt. I appreciate you coming on the show.
Yeah, absolutely. Glad to be here.
Awesome, awesome. I want to get right into it, but go ahead and give us a little bit of your background and everything, and then we'll kind of break this down.
Yeah, so I got into DD. Basically, just I have a degree in accounting, so I have a master's in accounting, and I work in data analytics. And really started to dive into DD when a lot of weird things happened with the market. You know, companies that should be going bankrupt weren't.
Mhm.
GameStop being one example. And just really started diving into financial statements to figure out what was going on. Discovered that there were a bunch of short squeezes happening, and just started keeping up with that. A lot of that data, a lot of that info was pointing back to the misconduct that was happening with hedge funds,
Mhm.
especially. Just it's hard to ignore Citadel. They
Mhm.
are just such a big piece of all this. So yeah, the DD just kind of kept following down rabbit holes and just started to compile a lot of this stuff. Try not to make too many assumptions and just rely on the data and spread the story for what it is.
Right, right. Okay. And so during your schooling, I think you mentioned to me before that they kind of taught you how to like reverse engineer and kind of like
Yeah,
see.
yeah,
Yeah.
yeah. So as an auditor, you are taught to look for ways or gray areas in accounting that could be exploited. And so you have this fraud triangle, which is the pressure to commit fraud, the incentive to commit fraud, and the opportunity. That's called the fraud triangle. And so the pressure, it can be, you have to make your quarterly sales. You have to meet finance's expectations. So there's incentive to maybe pinch a little bit more off of the revenue that you could possibly get, or your motivation might be, you want a bigger bonus. Somebody might want a bigger bonus, and an opportunity is like an internal control that you can exploit. Somebody's not checking how much money is being taken out of the register every day, and
Hmm.
so you're taught to look for these things. And when you start diving into Citadel, they're just, and other hedge funds, for example,
Hmm.
there are just so many red flags that as an auditor of Citadel and these big four accounting firms, Ernst and Young and PricewaterhouseCoopers is Citadel's auditor. They sign off on their audit statements, but not before doing huge consulting operations with them to say,
Hmm.
look, if you continue doing it this way, you're going to get caught for fraud. So if you design it in this new light, we can bend that gray area in accounting. So all of this is going on behind the scenes to allow for this, and allow for the auditor to say, yep, everything looks like it's presented fairly.
Wow. Okay. Okay. Man, that's so crazy. But I love it. I think that's super interesting. But let's take a look. So let's go over this of this stuff really quick. And let's go
Yeah,
over. Let's start. Where do you want to start? Repurchase, or do you want to?
sure. Yeah,
Okay.
yeah, yeah. So the everything short is based on the follow up really of Citadel. Just there are obviously, everybody knows at this point, there are all of these massively shorted stocks. And one thing that I discovered with all of this was I was diving through Citadel's financial statements, and I found this company called Palafox Trading. And Palafox Trading, which I'll discuss more in a little bit, but the intro to the reverse repurchase and the repurchase agreement was all of this started with Palafox, and Citadel owns 100% of this company, and they use them exclusively for repo agreements. Now, why are repo agreements significant here? A repo agreement is a very short-term, highly high turnover loan where somebody goes in. It's like a pawn shop. You go in and you have a watch, and that watch is worth $100. So you can go to the pawn shop, pawn it for $100, and then in a day or so you're going to come back and you're going to buy your watch back, unless you want to default on it and the pawn shop keeps the watch, in which case they can sell it, do whatever they want. um, so why is that significant? The repo market is like the plumbing system of the financial network, of the financial world. If a hedge fund or a bank, they have the liquidity issues. They've got, back in 2008. Lehman Brothers had too many mortgage-backed securities that they knew were just garbage, and they had to keep up this fraud in making everyone believe that they weren't garbage. And the reason for that is so that they could sell them in the repo market, and that's actually what got them popped for fraud. Was they were accounting for those loans, the proceeds from those loans, as sales, and it overstated their revenue. So the repo market is huge because they were able to take those mortgage-backed securities, which called like this toxic waste, which nobody else wanted, and they were able to throw them out in the repo market, never intend on buying them back, and then take the cash from it. So it was like um, this financial garbage washing machine, if you will.
Yeah.
And so leading into where we are today, the only difference that has changed is the mortgage-backed security has been replaced as the dominant choice of collateral by the U.S. Treasury Bond. And the reason for that is because with all of the QE ever since 2008, Treasury bonds are plenty, right? So you can go anywhere and find a Treasury bond, and then know that immediately you can toss it into the repo market and get some quick cash for it. So that's the significance of the reverse repo. A reverse repo agreement is the asset side of that. Like if you're the pawn shop and you know someone's going to come back and give you the money for your watch, you have a receivable. You're going to receive $100 in the future. The repo agreement is what you would account for as the person that's pawning the watch, because you have a liability and you have to go back one day and you owe money to buy your watch back. And so when all of that started to seize up in 2008, you took the liquidity out of the system entirely.
Okay, I see. And so as far as taking the liquidity out of the system here, like what does that mean in like today's terms with what is, how does this translate?
So in 2008, your repo rate, which was the cost of borrowing money, was right around that 6%, for I believe that's what about a year and a half, maybe a year. But the build up to that, the reason why that repo rate was going up was because enough of these people started to catch on that these mortgage-backed securities weren't really of any good. It wasn't good collateral. It's collateral, but nobody wants it. They weren't really AAA bonds. They were C bonds. Like it was garbage. And so there were enough people like Michael Burry and Mark Baum who started calling BS and started to short the mortgage-backed security. And so you have this repo rate that starts to go up because people say, hey, I would rather hold on to my cash than to hold on to the mortgage-backed security. So if you want to borrow it, you're going to have to pay me more money. And so instead of paying 4% on $100, which you would pay $4, now they're paying closer to 6%. That's a huge strain, especially when you're making these transactions daily. You can take those rates out and spread them out annually over a year, but these are very fast. 4% over the term of a repo agreement. If you have an overnight repo, you're paying 4% on that. So that buildup made it so expensive to continue doing the repos. And when the fraud came out that these were just they were complete garbage, nobody wanted them anymore. And so the repo system froze because you could no longer exchange cash. And that's when everybody realized, like, you have all these junk securities, but you don't have enough cash. And so when the Fed came in and started purchasing all those bad securities back, they were pumping real liquidity, financial currency reserves into or Federal reserves in the form of dollars back into the system. And it kept the repo rate down really low. So it made it so that the cost of borrowing money wasn't that high because now you have a lot of dollars in the system. Well, they started to kind of taper that program with the Fed started to taper back in 2018. And they started, I think it was like late 2017, 2018, when they started to taper that and they started to raise rates. Well, what happened? Well, you get to 2017, 2018, and everything seems to be fine. And then you hit 2019, you have your first little blip in that may even be the end of 2018, where all of a sudden one party defaulted and the overnight rate spiked up to nearly 10%. And then 9 months later in September, you had a huge default where there were two main catalysts, one of them being a big corporate tax payment that drained the funds from one of these commercial banks, and they didn't have enough money to pump into the repo market the next day. And what happened was the repo rate spiked to nearly 10%, which is that straight up line at the far right side of the graph. And this just goes to show you how tightly that control has to stay. When one person defaults, it triggers this chain of defaults all the way through the market. And so the Fed really had no choice but to do exactly what they did in 2008 in order to avoid something much bigger scale from 2008 and happening.
Okay, I see. Holy smokes. Jeez.
Yeah.
Uh,
Wow.
okay, and
So then,
mhm,
so really the follow up of that from that is when we start to get into if you go ahead and scroll down is the fear of triggering that, right, would essentially tank the repo market. And what the Fed started to do was buy back all of these in terms of like March of 2020.
mhm,
They said if we don't get a tight grip on this from September 19, 6 months later in 2020, they started pumping all of these stimmy packages out.
mhm.
And the reason why they had to do that was because if they didn't, there would be no liquidity in the repo market. Now, that has just been replaced. Those mortgage-backed securities have been replaced with treasury bonds because there are so many of them around. And
Okay,
so this is really the transition from this point into where we are today with Palafox.
okay. Am I here now, or where do you need me to go?
Yep. Go ahead and scroll down. This is just saying like
Okay,
in terms of the number of repos. Go ahead and scroll back up. That one
okay. This
right
one.
there. Yeah.
Okay,
So the picture above this just says that Palafox is owned by Citadel Securities. It's disclosed in their financial statements. But this is a makeup of the funds. It really boils down to a master fund for Palafox, which is a conglomerate of about 123 billion dollars in assets. And that web right there, if you scroll down a little bit more, that web just shows all of the child funds that feed into that global master fund, making up the 123 billion. Now, 80% of these are owned by offshore entities. I think it's a very suspicious, a very sketchy thing given Citadel's history. But I can't say definitively if anything is sketchy is going on. But just knowing that 80% of the 123 billion is being controlled by outside influence, and it's a direct impact on the repo market. The only thing that Palafax does is repos. So you're talking about having that much control
mhm,
um, over the repo market, which is incredible. But if you go ahead and scroll down, this is really the
okay,
juice of Palafox is to get to go ahead and keep scrolling, scroll down. Yeah, so right here. So what happens now in the difference between where we were at with 2008 was 2008 we didn't have enough liquidity, right?
mhm,
So the reason to hold on to your cash, if cash is scarce, you want to hold on to it. If you're going to lend it out, you're going to charge a higher repo rate. Now we're facing the complete opposite effect, and the lending rate for repos has gone down to nearly zero. It's been maintained this way really since the most recent stimmy check or the very first stimulus package was passed in March 2020. And it was designed this way because if you can keep the repo rate low and a bunch of liquidity in the system, you can almost guarantee that you won't have the situation that happened in 2008. You won't have a situation that happened in 2009 or 2019. The
mhm.
problem, the problem is when the effect that this has on the treasury bond is the increase in the rising rate in the treasury bond means that the treasury bond's price is going down. And because you know that there's going to be this continuation of liquidity pumped into the financial market because the Fed's going to keep their foot on the accelerator, you know these treasury bonds are going to keep coming. So what it does is it creates an incentive to short the bond market. And I have a lot of people that are saying like it's impossible to short the bond. Nobody's shorting the bond. Take a 5-second Google shorting the bond market, and you will find within the first one or two articles that people have been talking about this. It's just not on the mainstream. People have been shorting the bond market for years. It's speculative trading, and now that the presence of treasury bonds is available, I believe companies like or hedge funds like Citadel have overextended their reach because they are appears to be in the business of shorting more than they are long positions based
Mhm.
on their portfolio. And so now you have a company that you own exclusively that will do these repo agreements for you with bonds. And that's allowed Citadel to start what I believe is heavily shorting the bond market. If you go ahead and scroll down. So what basically happens here very quickly is Citadel will locate a lender, whether it's for a stock or a bond. They will locate a lender,
Mhm.
and in the disclosure with Melvin Capital, he was talking about Gabe was talking about how they will locate a lender, and they mentioned BlackRock specifically. And when you start digging into the relationship, this is what the post on BlackRock bag holders was all about, is there is this shadow relationship between Citadel and BlackRock. And Citadel, what I believe, has shorted a majority of BlackRock's portfolio. And now we come to find that the Federal Reserve, and this is old news, but the Federal Reserve tapped BlackRock to purchase bonds for the government. Well, that's just too coincidental, in my opinion, that now you have a lender of stocks and you also have a lender of bonds to arguably the most gifted market manipulator that there is today. And I say that with confidence. I mean, other than your big banks, Morgan Stanley, Goldman Sachs, and stuff. Citadel has a very unique niche in placing trades in the market at very manipulated prices. So they're taking these bonds, let's say from BlackRock, and they are shorting them, and they're shorting them to oblivion. And the reason why I think that they have shorted more bonds than actually exist, if you go ahead and scroll down, I believe that they have shorted more bonds than actually exist right here, is because the repo rate is starting to dip into a negative. And this implies that the desired collateral in a repo agreement is now the actual collateral being traded, not the cash. And so using our pawn shop example from earlier, if you have a watch that you brought to a pawn shop, you swapped it for $100, you're going to pay back 106 because it's a 6% interest rate. If you have a negative interest rate, that means that you go into a pawn shop, you pawn your watch for $100. When you go to get your watch back, you're only paying $95.75 because you are literally getting money from someone. You're making money from someone lending it to you. And the only reason that you would have that incentive is if the person getting that, but instead of your watch, this is a treasury bond. So now you're going in and you're lending a treasury bond. The bank says, I really need that treasury bond from you. In fact, I will pay you interest if you lend it to me. And they will use that to cover a margin call until this cycle keeps repeating. And BlackRock can keep purchasing more treasury bonds and keep pumping them into the market. So the Federal Reserve is really monetizing and systematically controlling the government, the spending of the United States government. And if the government does not continue to pump securities, treasury securities into the market, you're going to see this ginormous bond squeeze. And in fact, it could happen even before that.
Right. And this is something similar, right, to like how people are saying, this is why people are saying, AMC to 2000 isn't a meme. Is it because here, if it's worth more than your share that you have is worth more to them than like
exactly.
Right. So
than any amount. And that's the whole point is within the bond market, you are talking with two banks, or you're talking with a bank and a repo market, you're talking with a bank and a hedge fund, and they can agree to say, okay, yeah, 5% sounds good, but what happens if that bank has diamond hands and they say, well, we've got our treasury bond, we got our treasury bond and 5% isn't enough. They say, well, what about 10? Oh, that's not enough. It's the same exact scenario. And I mentioned this earlier, and I'll do it very quickly. Back when we were talking earlier, is the concept of what demand and supply really is in the situation of a short squeeze, because these companies have shorted more shares than exist, and they have not purchased them back. They can't. It doesn't make sense. The margin call, when this rings, it's not like you have one hedge fund that says, I'll cover 2 million shares and then we'll wait a week for the price to go down and then someone else will cover. No, it's because all of these shares have been rehypothecated and loaned out multiple times. They sit on everyone's balance sheet. And so when one has to pay, they have to go to someone else to get them to pay. And that person has to go to the person they've lent them to get them to pay. So we're talking about a squeeze occurring all at the same time and triggering a moonshot. And so you change the typical dynamic of what market demand really is. Instead of buying something for $10 and saying, does the market agree that that's a good price, where demand is the independent variable, you have a scenario now where the obligation to repurchase everything is the independent variable, and demand is dependent on that variable. So it's not like they can just say, all right, we're going to stop. No, the DTCC says you need to pony up, or the FICC for bonds says you need to pony up, and they have to go into the market at one time. So you're not going to have a peak. You're not going to have to worry about a peak. you're going to see just a straight moonshot. You might dip a little bit, but that thing's going to go to the moon. There's no way that it can't, because you decide what your selling point is. So don't view this as the typical market scenario. This is a 100% you decide when you're ready to sell.
Right, because they're being like they legally have to pay at that point, right? And they'll pay.
They legally.
And yeah, they legally have to pay, and you literally determine the price because they have to have a seller in order to buy. They have to have a sell, and
Yep.
so and then it keeps going up. This is what I've been telling people also. It keeps going up until there's an agreed upon price, and they're not going to have a choice. The price is literally whatever you, as in the shareholder, agrees upon.
Mm-hmm.
Oh, man,
that's absolutely right, and that's why getting into the FICC rulings and everything else coming up with the new deposit requirements for the SLR requirements being updated, because the DTC knows, okay, there are more short positions out there that we don't have enough money to cover if somebody fails to deliver. So if you guys are going to maintain these huge short positions, you're going to have to pay up. And as we discussed earlier, that 801 coming into effect, as soon as that's passed, it's very good news, because they have a short amount of time, a short window of opportunity to actually, I believe you said it was an hour. They have an hour. As soon as that margin bell starts ringing, they have to go in within an hour and grab all those shares.
Right. And they're going to have to, as soon as they say you need to pay, then that needs to be covered, which is exactly what we're waiting for. Man, insane.
Yep. Yeah, incredible.
Yeah.
And now this is kind of the banana in the banana split here. This is Palafox's financial statements. Year over year, they've jumped from about 5 million in these repurchase agreements to 5 billion to 7 billion to now 14 billion, and that's or 15 or 16 billion, and that's at the netted level. So for lack of a better word, netting is just more of this BS agreement saying we have another party that owes us, and it's an affiliate party, and so we're going to report in the event that they default, we know that they can actually cover, let's say, like a half of our liability. So I think here it's saying 30 billion or something. In the event that they default, we're going to net out the amount that we owe them. We're going to net out with the amount that they owe us, and so we're only going to show that amount there. Now the kicker here is if you look at the gross amounts up there at the very top. So you've got your repurchase agreements being $31 billion, and the breakdown of this is 30 billion of that is U.S. government securities. So it's like the typical mix was like maybe 20% mortgage-backed securities and 80%. No, when you look at Palafox, they're exclusive in U.S. government securities, and their repo agreements are entirely rehypothecated. So they won't be able. Go ahead and scroll down. Go ahead and scroll down right here. This is their assets. But this highlighted section here says, in order to, if they have $30 billion in repo agreements that they owe, but they have 31 billion in repos that they're owed, somebody's going to pay them. That a lot of people say that it's a wash, it's a net. And in fact, it would show that they're actually in a gain here. Unfortunately, the company has the rights of rehypothecation with respect to the securities collateral received under reverse repo agreements. So they're assets. And this means that substantially all securities, and we went through the breakthrough of this earlier, was like I think a difference of 100 million. So it shows down there at the bottom 31.39 and then 31.295 have been pledged to cover their liabilities. So what this is saying is no, they haven't. It's not a wash, because Ted needs to pay them $31 billion before they can turn around and cover their liabilities. And I personally believe this is why their liabilities have been going up so much, is because they can't cover all of those at one time unless someone else covers their obligation to them. And this is the downfall of rehypothecation. It's the exact essence of a fractional reserve. And the entire system has now come full circle to this. Everything has been shorted, and it's a gigantic global game of musical chairs.
Holy smokes!
And especially with that repo rate teetering in the negative side, it's looking pretty dim.
Yikes. Yep. And that's, I mean, it's insane. I wonder, and might be a little more speculation, but I remember in the rule, I think it was '04 that we talked about, yeah, I talked about yesterday in the channel, how it said that it's all going to go to basically a safe, I forgot the exact term, but like a safe, I don't want to say clearinghouse, but like broker, whatever, that, and it's all going to go to like one place. And I wonder if it'll be dispersed. I wonder how that's going to play out, but yeah,
That's interesting. Yeah,
yeah, there's going to
it's
be a
very
lot of
interesting.
exchanging of hands here of like,
Hmm.
you have to pay him back, you have to pay him back, you have to pay her back. Like you just, it's
Yep.
just going to fly around everywhere. Holy smokes. It's a web that will have to be
It's wild to
unwoven.
think about.
Yeah.
It's
Oh
definitely
my
wild.
gosh. All right. What else do we have here?
So that's really the overview of what's going on. Is the rest from this point forward is speculation on what could happen.
Mhm.
Obviously not financial advice, but just personally, what I've been doing is
Mhm.
just holding. The best way to know what's going on is to look at the data, and the facts show that these hedge funds are bleeding and hurting a hell of a lot more than you are by just holding onto a stock. So if
Mhm.
you think that as far as getting into the bond market and everything, there's a lot more room there for the Federal Reserve to just keep putting the foot down on the floor even harder. So if one thing is going to come out of this to prevent this from all falling through the floor, is you're going to see more of these bigger stimulus packages being passed to keep the availability of funds there, within control, within a tighter amount of control. So you're going to see more of these. They're talking about these green deals and paying Medicare for all, and it's very possible that they could pass that in order to keep the repo market solvent and to keep the treasuries flowing. So what that means for stocks is a very, very good. It's a very good indicator that that squeeze. If somebody starts to slip and default a little bit on the bond market, it could trigger a huge recall on the stock market, especially now because we have these new rules coming in. If the FICC says, you know what, you're not making your margin for bonds, there's no reason why the DTC wouldn't say, if you're not making it for bonds, you're not making it for stocks, and they just recall everything at one time, which could trigger the mother of all squeezes and start squeezing everything. And if in the likelihood that in the event that that doesn't happen, you're still seeing a huge opportunity here, especially with these new rules being passed, to just squeeze in the stock market and literally take this thing to the moon much quicker. It's terrible when you start to put dates on everything, but the likelihood of these things happening are all coming to a head. And the best thing is, all you have to do is just hold. Turn off the news. Turn off the stock market. Don't look at what your portfolio is doing. If you have a heavy investment in heavily shorted stocks, you're almost guaranteed that you're going to end up in a better position than the hedge fund. It's just a matter of time. So stop paying attention to what the media is saying. Stop paying attention to the fear. Just buy and hold. It's as simple as that.
Holy smokes. Yeah. And so this is something I've been saying also, we talk about these rules. They're passing these rules like crazy. And I think they're in anticipation of what's going to happen. And so this is, I've been telling my stream and the whole time, my chat, my viewers, that Rule 801 is the end all be all. That is the margin call. That is whenever these guys are going to have to cover. And just to reiterate that point, and we are going to determine what the price is. You, the viewer, the stockholder, is going to determine what the price is, because you get to hold it for as long as you want to hold until 500. That may be possible if everyone else holds. So it's
Your
extremely
uncertainty is the only thing working against you.
right.
Yeah. Yep. You're
Yeah,
absolutely right.
your own fear.
Exactly.
Exactly.
Exactly. And so if you can, if you can hold, this margin call comes up with 801, they have no other choice. They have to go out and buy the shares that they have available. And when you start to realize that there are a lot fewer shares in circulation than exist, because a lot of those are rehypothecated short shares. They're just shares that exist on paper and not in the majority of people that own those shares. A lot of retail investors, man, a
Hmm.
lot of retail investors that are holding are going to come out of this with diamond. I mean, just you're gonna convert diamond hands to diamonds. Let's just say that.
Yeah. Holy smokes, I love it. Yeah. Hey, this has been so fantastic. Thank you so much for taking the time, like
Absolutely.
breaking down the your DD. I'm gonna have you on the show again, absolutely. Um uh,
Yes. Oh, yeah. We uncovered that.
oh yes, guys,
We were looking through a Finya. Yeah, this needs
I'll
to
let
be
you say it. Go
discussed.
ahead.
So Yeah, so I was literally talking earlier, and we we started discussing the FINRA violations for Citadel, and I kept mentioning that there were 58, 58, 58. Well, we pulled up this report and we were just walking through it, and turns out there's 59. And guess what? FINRA has violated Citadel. The date initiated is 3/25/2021, and it is a Treasury security manipulation. They put on they were trying to state that a sale of a treasury was occurring to an actual customer when in fact it was a affiliated party. So the next time we come on, we're going to walk through this. We're going to have another DD to talk about why this very same thing that we were talking about in the everything short is now happening, and the FICC is doing the job they're supposed to be doing by passing all of these rules, and it's happening right now in front of us, breaking on this
Absolutely.
channel.
Yes, guys, we're gonna bring it to you. We're gonna bring it to you. So I've already spoken with Austin, and so we are gonna be bringing this all to you guys. He's gonna do his research, do his thing, come back on, and we're gonna talk about it. So I guess I'll kind of wrap up the video there. Thank you again so much for coming on,
Yeah,
guys.
great.
Yeah, guys. If don't miss this stuff, okay? If you did like the content, make sure you're subscribed. And if you're new here, welcome, welcome, welcome. Make sure you subscribe so you don't miss what's going on. I'm covering AMC, GameStop, the squeezes. I'm trying to get all this DD in here, so it's gonna be fantastic content as soon as I can get it out. Okay, you don't want to miss, especially this Rule 801. I think this is gonna be the big one for us. Okay, again, thank you so much for taking the time to watch the video. Be sure to hit that like button, and I will catch you all another time. Have a great night. Peace.